that smart money creates every single day on the price chart, then you're putting yourself at a massive disadvantage. These traps are the reason why so many traders enter perfectly good setups and still lose. Ignoring them can turn a promising trade into an instant stop-out. That's why in today's video, we're going deep into the most common and most dangerous inducement patterns that wipe out traders over and over again. You're going to learn exactly how these traps form, how to identify them on any chart, and most importantly, how to avoid them so you can finally stay on the same side as smart money instead of being on the opposite side of their trades. If you've ever wondered why the market keeps taking your stop right before moving in your direction, this video will answer that once and for all. We always appreciate your support, so please give this video a thumbs up and subscribe to our channel if you are new. See you after intro. Welcome back, traders. Let's get started. Inducements are setups the market creates that tempt traders to enter, often in the wrong direction, so smart money can collect liquidity. In simple words, an inducement is a trap for traders that makes them enter the wrong direction before the real move starts. Smart money wants liquidity, so they induce traders into early breakouts, fake reversals or fake pullbacks, order blocks that look clean but aren't the real ones, FVG fills that look like entries, equal highs or lows that look tradable, and etc. Then price reverses, sweeps their stops, and moves in the intended direction. So if you ask me why understanding inducement concepts is important, because it helps you avoid entering too early at fake levels or liquidity traps, and instead wait for the real point of interest. This dramatically improves the win rate. So, inducement means creating liquidity before the real move. It is the last liquidity created to fuel the real move, and it shows up in different forms: structural inducement, liquidity-based inducement, and time-based inducement. Now let's start with the structural inducement. This is the most important type of inducement, because it happens directly inside the market structure and forms patterns you see every single day. A structural inducement occurs when price creates a fake structure shift, like a false CHOCH or a misleading BOS, that tricks traders into entering early or in the wrong direction. In this example, the price is in an uptrend and keeps forming bullish breaks of structure to the upside. But if you focus on the most recent break of structure, at first view, it looks completely valid. Price broke and closed above the swing high. So naturally, you'd expect to look for buy setups at the demand zone or order block that caused that break. But then what happens? You enter the buy, and you get taken out almost immediately. That's how structural inducement traps most traders. And here's why. This so-called BOS was never a real break in the first place. The entire move was driven by the resting buy orders sitting below in the discount zone of the main bullish leg. If you draw your Fibonacci tool from the swing high down to the swing low, you'll notice that the price never retraced into the 50% level of the previous impulse. That means none of the discounted buy orders were ever triggered. So this move is not a valid BOS, and this is just a single impulse that hasn't mitigated its discount. When you draw the Fibonacci tool from the low to the high of this impulse, you'll see that the price must return to the discount area to collect liquidity, sweep the early buyers, activate real institutional orders, and only then continue higher. Understanding this prevents you from falling for fake structure breaks and teaches you how to align with the real direction of the market. Now let's look at another chart example. Now here, you can see that price is in a clear downtrend. But if you look closely, you'll notice something interesting. Price broke and closed above the major swing high of the last bearish impulse leg. At first, this looks like a bullish change of character, a signal that the bearish trend might be ending and the market is about to shift direction. So naturally, you might start looking for long opportunities inside the fair value gaps within this bullish leg. Or you might wait for the price to reach the bullish order block at the extreme. But every time you enter a buy setup here, you get stopped out and liquidated. The truth is, this is not a real CHOCH. This is a fake change of character, a structural inducement designed to trap buyers. Here's why. Price never reached the premium zone above the 50% level of the previous impulse. If you draw a Fibonacci tool from the swing high to the swing low, you'll see that this bullish move hasn't tapped into the premium area at all. So this entire move upward is nothing more than a pullback, a retracement to activate the unfilled sell orders that the market left behind on its way down. And that's exactly what happened here. Price took out the early buyers sitting above this swing high, which was an inducement level 2, tapped into the premium zone, reacted from an internal liquidity pool, a fair value gap inside the leg, and then continued aggressively downward. In scenarios like this, you shouldn't be looking for buys. You should be looking for sell opportunities. Otherwise, you'll get trapped again and again by the same pattern that most traders fall for. This is one of the most common inducement scenarios in the market, and thousands of traders step into this trap every day. Now let's continue with the second type of inducement. But before we continue, the liquidity-based inducement is the most common type of inducement. This is where the market intentionally creates a new high or a new low, or a small order block or breaker that is too clean, only to trap traders, collect their liquidity, and then deliver the real move. And this happens every single day on every pair, on every time frame. The main purpose of this course of action is to generate stop losses that smart money can use as fuel by taking retail into wrong trades so their stops can be collected right before the real move. This is why you always see a tiny high before price drops, a tiny low before price rallies, a fake breakout before a reversal, equal highs or lows getting swept by 1 to 2 pips. These are not coincidences. This is smart money intentionally engineering liquidity. Now let's go deeper with real price chart scenarios. Here we have a trading setup where price taps into a very strong daily demand and reverses, forming a valid change of character. So naturally, we expect the price to pull back into this bullish fair value gap sitting in the discount area, which is where we want to buy. But before price fully taps into the 1-hour FVG, something interesting happens. Price pushes downward, reacts slightly to the fair value gap, and then immediately reverses and forms a new lower low. This new micro low is pure inducement. This is where many traders get trapped. That minor low makes premature buyers believe that the price has already mitigated the 1-hour FVG, and that the reversal has begun. And because they fear missing the move, they enter early and place their stop loss right below that micro low, creating a clean pool of sell-side liquidity. But this is exactly what smart money wants. Smart money uses this inducement to trigger early buyers, build liquidity below price, make the market look weak, trap retail sellers who place sell stops under the micro low. All of those stops become the liquidity institutions will use to fuel the real bullish move. And once enough liquidity is available, price dips slightly lower, sweeps the inducement low, collects the stops, and finally mitigates the true fair value gap, the one institutions were targeting from the beginning. At this point, liquidity has been collected. The imbalance is filled. The true institutional POI inside the FVG is mitigated. However, inducement doesn't always appear as clean and simple as the previous scenario. Sometimes, instead of forming a small micro low, price creates a fake change of character on its way down, and forms equal lows just above a tiny clean order block. So now we have 3 components working together, a fake bullish CHOCH, equal highs, which build a powerful liquidity pool filled with retail stop losses, a fresh, very small order block that formed inside the CHOCH leg. This tiny order block is not a real point of interest. It exists purely as an inducement. Its only purpose is to lure traders in early and gather even more premature sellers before price taps into the major true point of interest below. Smart money uses this tiny order block to create more stop losses beneath it, add more liquidity to fuel the real move, encourage retail traders to enter early based on a false signal. Now you might ask, why does price have to form an inducement right before tapping into the fair value gap? Because if the price goes directly into an FVG with no inducement, then there is no liquidity. Smart money has no fuel to reverse the market. The reaction out of the FVG becomes weak. The entire setup may fail due to a lack of sellers to buy from. In simple words, inducement creates the liquidity that fuels the move out of the FVG. Now let's move to another trading scenario. This is one of the most common inducement sequences in smart money concepts, a pattern you will see every single day on the price chart. Let's imagine the price is in an uptrend and moving toward a key supply area. As price gets close to this zone, it begins to act strangely. First, price breaks a small swing high. This fake BOS immediately traps breakout buyers, traders who think the trend is continuing, anyone using tight stop losses. Right after this fake breakout, the market forms equal highs, or almost equal highs. This traps retail traders who think, this looks like resistance, let me short before I miss the move. These early sellers leave their stop losses right above the equal highs, creating a clean liquidity pool. Before the price reaches the real supply zone, the market often creates a small, clean order block by pushing and closing below the most recent higher low. With this single move, price has already swept the stop losses of the breakout buyers, the stops of buyers who entered from the fake bullish breakout order block. Then price immediately reverses direction and pushes upward. On this move back up, the market triggers the stop losses of early sellers who shorted from the tiny inducement order block, the stop losses above the equal highs. At this point, buyers and sellers are both trapped. Price action traders and even some SMC traders have been manipulated near a key higher time frame supply zone. Only after building these inducement levels does price finally move into the real institutional supply zone, the zone containing actual institutional orders, not retail traps. This is where smart money enters their true sell positions, and from here, the real bearish delivery begins, the move smart money intended from the very beginning. If price creates a clean micro setup right before a major POI, it's an inducement. So always wait for an inducement to form, then enter on the real POI behind it for having A+ entries. Now let's move to the third type of inducement, time-based inducement. Time-based inducement means that the market creates a trap move specifically during high-volume time windows, right before or after a major session open. This type of inducement is my favorite one, because the market does it every day, and it's the best opportunity to develop a trading plan and be on the same side as institutional money. Now you might ask, why does this type of inducement happen? It's because during major session openings, several things occur at the same time. New liquidity enters the market. New order flow enters the market instantly. Retail traders become most active, and smart money uses this exact moment to manipulate price and create a fake move to trap traders, collect liquidity, and then deliver the real move they intended all along. Let's look at an example. Here on the euro-dollar chart, price was moving sideways during the London session. As the New York session is about to open, watch what happens. Right at the open, price makes a fake push to the upside, sweeping the liquidity built above the London session high. Retail traders jump in with aggressive buy positions because price broke above a double top. And to them, that looks like a bullish breakout. But immediately after clearing the buy-side liquidity, price reverses sharply in the opposite direction and takes out the London low as well. With that move, both early buyers and early sellers get stopped out. Now, after price breaks below the London low, many traders think, okay, this is the real direction. The short is confirmed. But once again, the market reverses hard in the opposite direction, collects liquidity, and finally delivers the true move that smart money planned from the beginning. This entire sequence is what we call time-based inducement.